Joining us now to talk energy policy and much more, our guest host for the remainder of the show is Tom Fanning, Southern Company's chairman and CEO and deputy chair of the Atlanta Federal Reserve. Thanks. Good to see you.
Great to be here again. Good seeing you guys.
So let's start big. Talk economy. Not a great first quarter, obviously. It's negative. So we're counting on things to pick up from here. But with the situation now in Iraq, suddenly oil prices are headed back up. It's always something, isn't it? Value
is a function of risk and return. And it looked like we were kind of on a trajectory to get a little bit better in the United States economy. They were calling for 2.5 to 3% GDP growth, and now it looks like you may be south of 2.5, given that negative reduction in the first quarter.
If oil went to 120, it would even be worse, wouldn't it?
Look, the event risk around, and you think about it, so we have Afghanistan, and we have Iraq, and we have Iran, and we have Syria, and we have the Ukraine. And we have our own issues here in the United States, right? I've always described our pace of recovery as real but fragile. And I think we're subject to event risk more than we ever have been. The beta, if you will, of the worldwide economy is going up. Yeah. And I think as a result, value is going to be under pressure.
Because we like it. Like when oil prices go down, we think, oh, it's bad because it means the global economy is weak. And when they go up, it means, oh, that's good because it means demand. And but if it goes up for geopolitical,
demand, right,
it's not demand.
Right. No, that's
bad.
Not the good stuff.
That's like you're getting the worst of both worlds. That's a lose-lose.
But you know, there's a bright light in all this, and that is, you know, I've been talking a lot about national energy security and the whole bit there. The United States, I think, has an unprecedented moment with natural gas and with oil and with coal and with a variety of other things where we can be, absolutely.
We're going to destroy the coal industry. Maybe you're not on.
But Joe, we need to take this opportunity to keep coal alive.
You got to get with it, my friend.
Hey, we developed a technology we're deploying in Mississippi where
I'm not listening.
Hang on. We can combust coal.
Coal is history.
We can combust coal with a carbon footprint less than natural gas. And in fact, it has great appeal.
Sense to me.
But Joe, it has great appeal in China and in Poland and a variety of other places.
No,
listen,
I know.
We can be a net energy exporter.
It's a hydrocarbon, though, so is natural gas.
Hey, we can be a net energy exporter by 2020. We can be the biggest energy producer
now you're gonna make her mad.
By 2030. That's what we should do.
I know, I go back and forth on this.
She doesn't want to export. She wants to keep it all right here.
No. The benefits of exporting with job creation, personal income growth is so much overwhelming to the benefit of just keeping it here.
Explain that. How does it work? If we're importing natural gas and other, let's say, coal or other things, that creates jobs just because it's people who are working on.
Because we're exporting, you mean? Yeah, absolutely. And in fact, my sense is we can create this benefit for the United States economy. It's not just the jobs associated with mining or the jobs associated with extracting the gas out of the tight shale formations and everything else. My sense is that natural gas prices, for example, will find their place whether we export or not. And so my sense is, let's not constrain exports at all. Let's pick up all the economic advantages. Think about restoring America's balance sheet in terms of trade deficits and a variety of other things.
You think natural gas prices are going higher regardless of whether we export or not? Is that what you mean when you say find their natural place?
They will, because even at $4.50, say that's what it is today per million BTU. Whether you export or not, they will find a place somewhere in there, is my guess, range bound between 4 and 6 is what I think. But if you don't export, what they'll do is quit producing out of the wells they already have. My sense is you create a much better benefit for growing the United States economy, adding jobs, adding personal income growth, and it's the way to go. Yeah. Take advantage of the moment now.
I think that I saw something yesterday. It showed green, dark green was where the most jobs were added in the country. Light green was, and they had the entire map, and then they had where jobs have been lost. And you could just see it. You could see it right in the North Dakota, South Dakota, Texas.
But, man, don't get trapped in the idea that the jobs are just associated with the extraction of the resource. In the Southeast, we're seeing a renaissance of manufacturing. We're seeing something like 2.8% growth in industrial sales, which is really pretty good.
Yeah.
Jobs will follow that.
You're not ignoring solar, even though it still is probably the least economically. So you go nuclear, you go solar, you go coal, you go gas. You're everywhere. But so solar, when you just did a deal with what? With Turner Renewable, or with
we've
First
been doing
Solar.
that forever, yeah.
So it's viable, and you can do a certain amount of homes with that. It helps your portfolio just to be diversified.
Well, so here's the deal. Where we've done most of our transactions with Ted Turner have been where the solar resources are strongest. That is probably the desert Southwest, right? So New Mexico, Nevada, California, a wee bit in the Carolinas. That's where we're doing that business. Now, Andrew, what you just picked up on, we're the largest voluntary solar program in the United States in the state of Georgia. So we're doing it kind of in a variety of places. So it's interesting.
And are you making money or losing money doing that?
Oh gosh, we're making money. Oh yeah, no, that. But
the margin on that business is what relative to every other source of energy?
It's fair. Let me put it that way. So here's the deal. About 50% of the economic value of renewables is tied up in tax benefits. In other words, EIA themselves, I know it's crazy, EIA themselves has done their own study that shows that something like for tax preference item on a per unit basis, per barrel of oil, per million BTU natural gas, whatever, it's about 100 times what's accorded gas, oil, and coal, 35 times nuclear. Well, that's crazy. But we take advantage of it just like everybody else.
But take the tax credit out, can you make money doing it?
Not in prices in the Southeast. Heck, no.
Warren Buffett has made some investments in this area, and has said he's only done it in part because of the tax credits as well.
Well, of course, that's where the advantage
does win too because of the tax credit.
And that's where I've been on here before talking about tax reform. Look, I'll take advantage of those things as well as anybody else will, but they don't make sense in the national energy portfolio. We need more nuclear, need more 21st century coal, natural gas, renewables,
21st century coal. I like the way you say that. Well, we'll talk about the latest EPA stuff too.
Absolutely.
Okay.
Well,
anyway.
we got to find our way through it.
Nansen Saleri, who is QRI Group President and CEO. He is also the former head of reservoir management at Saudi Aramco. And Nansen, it's great to see you this morning. Thanks for coming in.
Well, thank you. Good morning to all.
Good morning. Let me ask you, last week Boone Pickens said that without the oil that we get from Iraq, he would see oil prices rising to $150 a barrel. What do you think?
Well, I would agree. Right now, there's definitely a sufficient reason to be alarmed, but no need to be in a crisis mode. I do see the current escalation of hostilities to have an impact in the order of $5 to $10. If the escalation spills over beyond the borders of Iraq and it becomes a regional crisis, then, of course, much larger increases can be expected. So let's hope for the best.
Right now, we're looking at oil sitting just below $107 from WTI, and that's something that certainly starts to raise brows here in the United States. But what happens with OPEC? Will they respond to a situation like this, or is this still within what they consider to be a normal range?
No, I think not only OPEC, but the rest of the global suppliers will be responding. And within OPEC, the main player is Saudi Arabia, and there's definitely spare capacity there of anywhere between 1 to 2 million barrels. And we have to put things in perspective in that Iraq's current production is about 3.4 million barrels per day, and their export capacity is about 2.4 million. So recognizing that there is going to be a diminished capability of export, say maybe up to 30%, that can be certainly mitigated through various means, through the spare capacity coming from Saudi Arabia.
Nansen, this is Tom Fanning. What's your sense as to the time value of this dislocation potential? How much could the United States make up in what time frame?
Well, the U.S. is producing all it can. Right now, its production is around 9 million barrels. Texas itself is producing 3 million barrels per day. So definitely, the U.S. is part of the global market, and more importantly, is part of the global energy market in that the U.S. is the #1 energy producer in the world, just exceeded Russia. It produces 22 million barrels oil equivalent on a daily basis. So it's a major, major player, and its production hasn't peaked yet. Certainly in the years to come, in the months to come, its production is going to increase. So the U.S. plays as a very important stabilizing factor in the global energy markets.
You know, Nansen, our international correspondent, Michelle Cabrera, is in northern Iraq right now, and she's been talking about how the Kurds would like to be exporting their own oil. Maybe they don't say it out loud in terms of wanting to be independent, but do you think that that is a likely situation, that the Kurds would be able to continue exporting the oil coming out of those northern fields?
Well, as you know, right now their export capacity is significantly diminished because the Kirkuk-Ceylan pipeline, which has a capacity of 600,000 barrels per day, has been out of commission since March. So it's true that they have a significant production capability right now. Maybe 25% of the total production from Iraq comes from the Kurdish area, but their actual export capacity is limited to basically trucking. And in the long run, there's no question that given their reserves in the Kurdistan region, they're going to be a major player. It all depends on the total stability in Iraq and the ability of the Kurds to protect the infrastructure that allows them to be major suppliers. In the current crisis, they cannot be a major player. Most of the Iraqi production right now, it's coming from the south, and fortunately, they're not very much affected by the current hostilities in central part of Iraq.
And Nansen, just quickly, can you tell us what Russia and the tensions we've had with Russia and Ukraine, what that adds to the picture?
Well, you know, that's a very interesting play in that people are talking about worst-case scenarios. One worst-case scenario would be, it's almost like a perfect storm. If the crisis between Ukraine and Russia escalates, that's going to be another anxiety premium on the world energy market. So hopefully that's not going to happen. The worst-case scenario is that escalation of hostilities between Russia and Ukraine, concurrent with a spillover effect in the Middle East, then definitely you're going to see price increases well beyond the $5 to $10. Yeah. In the short term, I don't think these are likely scenarios. The most likely scenario is a relatively limited, diminished capacity in Iraq, about a $5 to $10 premium over and above what's happening right now.
Okay. Nansen, thank you very much for joining us today. We appreciate it.
You're most welcome. Always a pleasure.
Tom, you agreed with that. You said that is one of the worst-case scenarios where you'd see much higher if there was renewed pressure coming
energy security breeds national security, breeds economic security. This is just another fact that says we need to pursue a different course for energy policy in America.
Thank you.
Okay, coming up, let the game of Let's Make a Deal begin with the man behind Morgan Stanley's biggest transactions, making his way to the table right now, Robert Kindler, Morgan Stanley Vice Chairman and Head of M&A. He's going to be our special guest when we return. Joining us now is the man behind Morgan Stanley's M&A empire, Rob Kindler, Morgan Stanley Vice Chairman and Head of M&A. You've been involved in a lot of these transactions that have taken place over the past couple of weeks. Can we start with inversions?
Sure, sure.
How many more are we going to see? Do you think this is a good policy? Do you think there's a policy response? What do you think is going to happen here?
Look, at the end of the day, inversions, they've been around for a while. I mean, we did one of the earlier ones with Cooper Eaton. It still comes down to fundamental value of the deal. You know, people don't do deals just for inversions. And the fact is, if you're a target company, you're on the other side of these inversions, you want some of that value in the deal. So it's not exactly like, you know, that for the buyer, it's all just upside. I think there will be
there's a lot more of them, though. I mean, I know they've been around for a long time, but it seems like there's this huge boom. And is that a reflection of U.S. tax policy?
Yeah. I think there's a lot to that. Sure,
of course.
Sure.
So, but here's the question I have. When you're in the boardroom talking about an inversion, somebody has to decide that the tax policy in either Ireland or the UK or wherever, because you worked for Pfizer in the AstraZeneca deal, is...
We worked for AstraZeneca.
I'm sorry, AstraZeneca on the Pfizer deal. Somebody has to decide that that is a better... that somehow that regime, long-term, will always be better than the regime here, at least for the next 10 years. What does that math look like? How do people talk about that?
Well, remember, these companies still pay taxes in the jurisdictions where the income's generated. The issue is, so, in that case, Pfizer will continue to pay taxes for income that's generated in the U.S. The difference is that there are ways that you can reduce taxes on the cash that's trapped overseas.
Do you think there should be a policy response?
I don't think it's likely near term. I really don't think it's likely near term. Maybe the policy response should be to reduce corporate taxes in the U.S.
Yeah, right.
Let me ask you about something else. You're now involved with this Valiant transaction.
Right.
You're working for Valiant.
That's correct, yeah.
And we've had Bill Ackman on. We've had the CEO of Valiant on. We've had Do you have an issue or even a question mark about the approach of having an activist investor attached to a corporate in a hostile transaction like this?
Well, it's part of the strategy in the deal, but the acquirer here is Valiant. I mean, Valiant has been the one who's been out front, and they're the one who's buying the company.
Oh, do you think we're going to see more of this? I mean, Bill Ackman now says that he's friends with Carl Icahn. Do you know of instances where Carl or Bill or others are now talking to companies strategically and saying, let's go after X company and let's do it this way. I'll buy up the shares in advance. We'll do this.
No,
I mean,
no,
you're a CEO.
I think it's pretty.
What do you think of this?
Rare.
I think that's crazy. Look, you do strategic deals because they make sense, because there's synergies between the companies. You got to think long term. You don't do deals because you think interest rates are low. You don't do deals out of a perturbation in tax policy. You do deals because fundamentally they make sense long term.
Well, look, I totally agree with that. It all comes down to intrinsic value. And the fact that rates are low doesn't have much meaning. I mean, you have to pay the money back.
Yeah.
Now, the fact is also that the market likes M&A because they feel that companies can't get organic growth. But that's still not a reason in and of itself to do it.
We had Scott Sperling from THL on last week, private equity. He said that when he looks around, that he thinks at this point strategic buyers have a big advantage over private equity at this point. I'm not sure why he thinks that. Is it because premiums have gotten so high that you better be able to find some synergies in order to make things work?
Well, actually, premiums over market are relatively low by historical standards.
Like 46% above.
Yeah. Well, there's a couple of them, but if you look at the average for this year, it's between 25 and 30%. The reason that premiums are lower, the Covidian deal this morning, it was 29%. Yeah. The reason the premiums are lower is just because the market is up. But multiples are up, and with multiples of cash flow are clearly up, and the strategics can absolutely pay more than the private equity.
Valiant, just back to Valiant for 1 second, which is Jim Chanos came on. He is short Valiant. What does he know that you don't? Or
that was the other piece in the Times. PIOT and Botox and Allergan.
Yes.
That was the other piece.
Right. Sorry, we were talking about an article in the New York Times over the weekend.
That was the other
segue, but that
was the other piece.
You have to watch the show.
But it wasn't that positive. I didn't think about Allergan because they act like they're this big R&D company, and really all they've done is just commercialize Botox for everybody.
Making your face smoother.
Look
at that smooth face.
It's important. Yeah, mine.
You have to again put things in context. It's very hard to do a hostile bid. It's just hard to do, and the circumstances where you can succeed is if, first of all, you are pretty convinced that there aren't any white knights, which clearly seems to be the case, at least that's what everyone says, with Valiant and with Allergan. And secondly, if the target has some gap in its takeover defenses, which, of course, Allergan does. And these things take time. I mean, a lot of people are, why is this taking so much time? Look at Sanofi Genzyme. Sanofi Genzyme took 7 months to get done. But that was exactly the same circumstance. There were no white knights, and that company's board could be thrown out. So here it's just a question of, tell me who the white knights are. There aren't any. This premium is a lot larger than the premium that was paid even today in Covidian. And so the end of the movie's clear. It's just going to take some time.
Have you ever done an analysis of how much value is at the end of the day created for shareholders via hostiles?
You mean from the target perspective?
Yeah.
Well, look,
I mean, at the end of the day, you're going to have a combination out of a hostile with a great big premium. You need to earn return on and return of capital.
Oh, this is from the acquirer's
standpoint.
Look, you're absolutely right what you said before. It's all intrinsic value. At the end of the day, you have to do the math, and these things have to be, it cannot be financial engineering. It has to be intrinsic value.
Right.
And again, you look at the Sanofi transaction. that was tremendous for the Sanofi Genzyme, was tremendous for Sanofi.
Last time you were on CNBC, I think with David Faber, you said the M&A market was going to the moon. What does it look like by the end of this year?
Well, look, so far it's been driven by large deals. So the volumes are up over 60%.
But not total number of transactions.
But total number of transactions is only up about 10, 15%. But I think it's going to continue to be a pretty good year. I think by the end of the year, we'll be up 40 to 50% in volume and 15 to 20% in deals.
Okay. Animal spirits are back. Thank you, Rob Kindler.
Thank you.
Appreciate it.
Thanks, everyone.
Welcome back to Squawk Box here on CNBC, First in Business Worldwide. I'm Joe Kernan, along with Becky Quick and Andrew Ross Sorkin. And our guest host this morning is Tom Fanning, Southern Company's chairman and CEO. And when we talk about the Atlanta Fed, you're like the business, like you tell the Fed what's going on down there. You're not really on that.
I hardly tell the Fed what's going on.
Yeah, but you're not voting on tapering and stuff like that. You're telling them how business is.
Every 2 weeks, we get a recommendation as to what they should do with rates, and this is ultimately driven into the FOMC.
They don't have to listen.
So we agree.
And this is Lockhart you're talking to down there?
Yeah, he's a terrific guy.
He is. Yeah. All right. So he listens to you, but you're like when we say you're with the Atlanta Fed, you're not really with the Atlanta Fed. You're kind of with.
He goes to meetings.
You're not government. You're not on the FMC. They don't have. They say, okay, here's this business. This business guy's in there. So tell us.
Actually, I would give the Fed great credit with trying to get good input as to what's going on in the economy. I give those guys a lot of credit. I think they're terrific.
Yeah.
I really do, honest and truly.
And the last 5 years they've distinguished themselves?
So where would we have been without them?
I don't know.
Now the question is, here again, value is a function of risk and return. How much return did we get, i.e., how much did GDP grow because we did certain things? How much risk did we take on? It's a fair question as, did we take on more risk than the growth warranted? And I think they're unwinding now the QE position. That makes sense. So,
Well, if they can orchestrate this perfect story and this perfect narrative, then we're going to be fine. But there are some people that think that the volatility has been masked and that there's some type of imbalances elsewhere. The asset prices are too high.
Well, I agree with that.
Well, and it could we haven't written the epitaph yet on all the, and it could be there are people that think it's going to be. That there's something looming ahead of us that could be very, very problematic.
Well, and isn't that the $64,000
But no one knows what it is. Feldstein thinks it's inflation. Other people think it could be a lot of...
Well, inflation is stubbornly low,
It is, I know.
And the unemployment number that they keep targeting, and I think they get this, but my opinion anyway, is a totally false statistic, right? Because when you count unemployment, you count part-time and all the people that have checked out.
But they're saying that the people that have checked out are checked out. So there's not enough people that are going to hold down wage pressures that once we do get a little bit lower, that half of those people are gone for good.
Man, I think there's still a lot of
Well, then you disagree with Kruger, not Freddie, Allen.
I think there's a lot of sloppiness in the unemployment numbers, so that as the economy starts to come back, we'll still see
some of those people come
persistent kind of.
It'd be good to get that participation rate back up.
And here's the other deal. Look at household incomes. I'm tending to look more at those kind of numbers in terms of my own business than I am in terms of just gross unemployment. Household incomes aren't growing at all. Why? Well, for all the benefits that we're seeing in industrial sales, which I think are good and will persist over time, we're seeing much more job growth in the service sector, much more low-paying jobs, much more people shifting into part-time as a result of a variety of external factors. That's not good for America. We need to restore household income growth.
Welcome back, everybody. Let's get some more on the markets right now. Joining us is Liz Ann Saunders, the Chief Investment Strategist and Senior Vice President at Charles Schwab. Liz Ann, it's great to see you this morning.
Hi, Becky. How are you?
Good. Good. I know you're concerned that we could face some geopolitical risks, but I think what's interesting is you also believe we could be looking at a melt-up under some scenarios as well. That's been one of the risks that we've been writing about for much of this year. I think that sentiment is frothy enough, and there's enough momentum in the market. Now, sentiment is also frothy enough that it makes it vulnerable, the market vulnerable, I think, in the short term, to any kind of exogenous risk, whether it's geopolitical, obviously the relationship to oil prices, or I even think the Cantor news last week may have caused some problems. I actually think it would be healthier if the market had more of a consolidation here. So if I had my choice, I would prefer a correction versus a melt-up.
Correction of 5 to 10%, or are you thinking a bigger move down?
Something in the 10% I think would be fairly healthy. It would actually be less than your typical midterm election year pullback. Since World War II, it's averaged about 18%, usually concentrated in the middle part of the year, and then you add in the normal annual seasonals. And this is a particularly tricky time for the market. I guess the good news is, particularly for someone who doesn't think it's appropriate to try to time around something like that, which I wouldn't recommend, is that we are moving into what is historically the strongest several months for the market coming out of this, both from an annual seasonal perspective as well as from an election cycle.
Does that mean you think things are overpriced here? It's gotten frothy. You've used that term a couple of times. Do you think that you'd be telling people, even though you don't say to time it, to hold off for now?
First of all, I think it's sentiment that's a little bit frothy. Valuations, not so much. We're at about median valuations, either on a trailing or a forward basis. Bull markets don't tend to end at median valuations, so I don't think that's an impediment. And with earnings growth picking up probably close to double digits at the end of the year, I think those fundamentals are enough to keep the market going. But I think sentiment is a little bit tricky. So, yeah, if you're itching to put money to work, you may want to wait for a slightly better entry point. The problem is that some of these midterm election year pullbacks, the rallies that tend to happen after them can happen in a fairly fierce manner. So, of course, trying to time the market means you've got to get out at the right time and back in at the right time. So maybe keep the cards a little bit close to the vest in the near term, but I certainly wouldn't suggest taking everything out now in anticipation of some pullback.
It does seem like a really unusual time in the market when you consider we've just had this negative correction in the first quarter. We have stock prices testing some recent highs. We see all this event risk everywhere, and yet we see the University of Chicago Uncertainty Index, after being very high, coming down, the VIX at an all-time low or a recent low. It just seems like there is an inequality as to perception and reality in the market, and I think it suggests that your kind of prediction may be true.
You know, the sentiment environment is really amazing because we talk about sentiment being frothy, and we can point to things like American Association of Individual Investors or Investors Intelligence, market vein, put call ratios. Any of those normal measures suggest that optimism is extremely elevated. But interestingly, and I hear this anecdotally, Gallup does a survey, they've been doing it since the late 1990s, that asks a very simple question of the respondents. Do you own stocks in whatever form? Individual holdings, through a 401k or an IRA, through mutual funds. And last year's reading at the end of last year was the lowest in the history of that survey. So it's almost like people have decent exposure to the market. Flow of funds shows that households are a little bit overweight equities now relative to the long-term norm. They're not even willing to admit it, though. So I do think there is a big spread between short-term sentiment and those traditional measures that show elevated optimism, and still this kind of skepticism, wall of worry longer term. And I think that's what will keep this bull market afloat.
But the challenge there is, where else do they go?
Right. Well, and that's the purpose, I think, of central banks, certainly the Fed, is to make, safe investments so yield-starved that people are forced out the risk spectrum. And I think from a business perspective, I think we're going to see that. I think we're starting to see animal spirits kick in. CEO confidence is up. Even NFIB confidence is up. So I think that's the next positive fundamental story, maybe not imminently, but that we're going to see a shift toward capital investment and away from just returning cash to shareholders. And I think that'll be an ultimate support for the market. But near term, I'm a little cautious.
All right, Lizanne, thank you. Great to see you.
Let's continue to talk about what's going on in Iraq and monitoring the latest developments out of Iraq. U.S. Secretary of State John Kerry is saying drone strikes, quote, may well be an option to stem ISIS advances. Let's talk about, though, the impact of the situation on oil right now. Joining us Lima Croft. She's the head of North American Commodities Research at Barclays. Before that, she was the Intelligence Fellow at the Council on Foreign Relations and also worked as an analyst at the CIA.
An analyst.
An analyst. Yeah. And you're not an analyst anymore.
That's cool.
Well, I don't have a gun, so.
You don't have a gun, but you're not on the payroll? Do we know? How do we know?
I'd have to kill you.
I think you may.
That's the normal answer.
So walk us through the permutations of what happens from here.
Well, the thing about Iraq for the oil market is it's OPEC's second largest producer. So everyone is very concerned if you have some big supply disruption coming out of Iraq. But in the medium term, Iraq is so important because nowhere outside of North America can you add so much crude to the market as Iraq. The IEA came out last year and said 45% of new supply growth over the coming decade is supposed to come from Iraq. So if oil companies are afraid to make those investments now, you're going to have a much tighter market over the medium term.
Okay, we've heard, though, that in the short term, at least in the north, we might actually see more production. Is that right?
Well, this is the interesting question. Does Kurdistan walk away with it all? And what you've seen recently is you've seen the Kurds move into disputed territories like Kirkuk, which is a major oil field. And the question is, will this be the signal for Kurdistan to basically walk out of the Iraqi Federation? And you had a previous guest on talking about Kurdish exports. They have an independent pipeline that runs to Turkey. 2 tankers have loaded with 2 million barrels of crude. The question is the U.S. going to potentially get behind independent Kurdistan? When John Kerry comes out and says no, but we have to see.
What would Turkey do in that situation, too? There are Kurds who live all over the region.
Turkey has done more to empower an independent Kurdistan than any other nation. They allowed that pipeline to be built over the objections of the U.S. We said don't build it. It will undermine a unified Iraq.
Well, what are you going to do in terms of developing storage, other infrastructure, pipes, everything else, in order to hit the kind of numbers that you're suggesting?
This is the great question, because Iraq was looking at, or they projected to export, they're doing about 2.5. They were saying they would go to 3.4. There was no way they'd go to 3.4 without additional storage, pumping stations. And the question is, A, will the Iraqi government devote the funds now? They're having to deal with a virulent security threat. Will companies put the money in? They're taking their employees out right now.
So give us a sort of short-term play right now if you're an investor.
Well, short-term, you really do not want to watch over the next couple of days if you have any threats to the oil facilities down south. Those companies are starting to withdraw those workers. If you have anything happen down there, even bombs in the vicinity, that will send prices much higher. And we don't, Saudi Arabia has the spare capacity, but that's about it right now.
So what's much higher?
Well, much higher you want to watch. If you have a facility go offline, after what happened in Algeria with that facility being attacked, I think a lot of companies will preemptively shut down. So it wouldn't just be what happens at one facility, it's what the other companies do down south, and that would be a significant move up in prices.
Would you say significant, though, but you want to posit a number?
Boone Pickens said without Iraqi oil, we'd see WTI at $150.
You'd certainly be well north of 120. That would prompt an SPR release, obviously, in the U.S. But again, the question will be then, how fast can Saudi Arabia bring on the additional barrels?
And what's the answer to that?
Well, we don't know. We think Saudi has an additional 2.5, but how fast can they ramp up? Uncharted waters.
Okay. What do you think of this?
I sound like a broken record. I think the United States has the ability to respond given the right energy policy, build the pipe, develop the resources we've got, make America stronger, improve our national deficit, everything else. Look, I think the advantages of us stepping into this void, if you will, is enormous to the United States economy. It could add 2 to 4% GDP growth, add 3 million jobs by 2020.
Okay.
Let's get back to our guest host today, Tom Fanning. Tom, Southern energy companies have a really good idea of what's happening in the economy. We had a lousy first quarter GDP, but what do you see right now from customers?
Yeah, so we're starting to see a continued, sustained improvement in industrial sales. Now, what we're seeing is that the industrial sector, while it's growing at about a 3% clip in the Southeast, still is not adding the jobs. All the job growth is coming in the service sectors. And so what we see now is this issue of personal income growth, household income growth, which is going to sustain the improvement in the economy, being relatively flat. And so what we want to do is add the good, high-paying jobs in a sustainable way. That's going to make the economy take off.
I wish we had more time with you. We always appreciate when you come in. Thank you so much.
Great. Always great being with you guys.
Tom Fanning, thank you.
Awesome.
I'll see you in Aspen.
Yeah, absolutely.
Okay. Make sure you join us tomorrow. Squawk on the Street begins right now.